Since my last portfolio update, 5 companies in my portfolio raised their dividends. This is the power of dividend growth investing. In this video, I will show you why I picked these companies to be in my portfolio, because they possess the ultimate mix of current dividend yield and dividend growth rate. And I will also give an update on my portfolio. The current value of my portfolio is $18,328, with a total return, including dividends, of 51%. My biggest 3 holdings are CVS, Omega Healthcare Investors, and Williams-Sonoma. Now on to the companies that have raised their dividends recently. Let's start with CVS. They just raised their dividend with 10% from $2 per share to $2.20 per share. That raise adds about $7 extra in my pocket every year. Not bad for not having to lift a finger. And I cannot express enough how excited I am about this raise. I am an investor since 2017 and have been patiently waiting until they paid down enough debt from their Aetna acquisition. I was expecting this raise for a while already and announced it a few times in previous portfolio updates. So why did I buy CVS in the first place? At that time, I really liked the combination of current yield and the dividend growth rates at the time. Little did I know that I had to wait 4 years for the next raise. Their revenue and profit growth was and is amazing. They have a strong moat in a lot of their business segments, and most of all, I really like their business model, where they are moving more and more towards subscription-based revenue. My only regret, not buying more when CVS was down in the $50 range. The other company that has also increased its dividends is one of my recent favorite stocks, and that is Enbridge. And with a current yield of 7.2%, the 3% dividend increase only adds more dividend income to my portfolio. But Tom, their dividend payout ratio is 120+%. That is not sustainable. Yep, but Enbridge is a pipeline company with lots of depreciation, so it is better to look at the DCF or distributable cash flow ratio, which sits at a good 70%. I like Enbridge as a pick in the energy sector because they have a predictable revenue through their long-term contracts with big oil companies such as ExxonMobil. And they are not reliant on energy prices, because they are paid based on the amount of energy running through their infrastructure. Tom, oil is dying. How does this affect Enbridge? Great question. It does and it doesn't. Long term, the energy transition will ask them to change. But in the shorter term, there's still a lot of demand. And Enbridge looks out way into the future with investments in solar and wind energy in Europe. They are also working on other energy sources such as hydrogen. I've made quite some videos on Enbridge already, so be sure to check them out. Before we dive into the next exciting dividend raises, how much dividend income did I receive in the last few months? In September, I received $39.34, up 64% year over year. In October, $15.86, again up 71% year over year. And in November, $70.33, up 26% year over year. Pretty happy with that. Since the last portfolio update, I invested $665 into my portfolio and bought more shares of Broadcom and Visa. I will show you more portfolio statistics in a bit. I always love to see those. Speaking of Broadcom, like I already predicted in my stock review video on Broadcom, ticker AVGO, they raised their dividends with double digits, adding to their strong dividend growth history. Broadcom is a stock I recently added to my portfolio because they possess the ultimate mix of current dividend yield and dividend growth rate at the time. That dividend growth is also supported by healthy and growing profits. The trick in these situations is to understand what the future holds for a company like Broadcom, to see if the dividend growth can continue. And with Broadcom being one of the largest chip makers in the world, in an ever-growing chip industry, I sure think so. Broadcom also has the ability to make spot-on acquisitions when needed, to stay on top of innovation. In the last few years, this has led to an increasing diversified revenue stream, with several acquisitions in their infrastructure software segment. Another company in my portfolio that raised their dividends, albeit with only 2%, is VF Corp. Being in the retail space, VF Corp was hit quite hard because of the lockdowns. Just look at their profits in 2020 and 2021. And for a bit, their dividends were not even covered, which can be concerning. But that pain was temporary. And despite that, VF Corp still managed to raise their dividends. VF Corp is most well known for brands like Vans, the North Face and Timberland. These brands make up a large part of their sales. VF Corp is continually transforming their portfolio by divesting and acquiring new brands. Growth factors for VF Corp are expanding further into Asia, a hyper-focus on digital sales and new markets such as streetwear with the recent acquisition of Supreme. They expect to be growing their brand sales in high single digits to low double digits until 2024. VF Corp expects an annual shareholder return of over 16%. That a company like VF Corp has raised its dividend, even though minimally, in these difficult times is a good sign to me. Next up is Visa, the highest dividend raise of them all, 17%, fitting in very well with their 5-year dividend growth rate of 18%. That yield though, Tom, it is so low. I know, the current yield of 0.7% is not the highest of the bunch. But with a dividend growth rate of 17 to 18%, that adds up pretty quickly. In fact, it would be a yield on cost of 16.5% after 20 years. You need these fast dividend growers in your portfolio as well. And it still beats the hell out of Apple and Microsoft, who have similar yields but only a dividend growth rate around 10%. Okay, not in price appreciation, but Visa still appreciated by over 160% in the last 5 years. Some bonus overviews of my portfolio. My portfolio based on the weighted holdings. CVS is by far the biggest. Dividend income has been steadily climbing over the years, both due to new cash inflows and reinvested dividends. Most notably, T. Rowe Price and Williams-Sonoma, both bought around the 3% yield, and now a return on my investment of 6 and well above 5% respectively. That is the power of dividend investing. My portfolio value also has been steadily climbing along the way, now at a bit above 18k. Forward dividend income is at $613, the biggest contributor being Omega Healthcare Investors. If there's anything I want you to take away from this video, it is that dividend growing companies give you more and more dividend income over the years. Your portfolio can grow even if you are only able to add a little bit each month. I started with only adding about $120 each month, and now some months I already get around $70 in dividends. If I can do it, so can you.